Well, good day, everyone. This is Tom Marshall, Virginia State in Retirement, with a month end update. Today is March 1st, 2020. What an interesting week we have had in the stock market. We're going to go over that information today and kind of give everybody an update of what the models are seeing and what's going on and that sort. But what is interesting, and for those of you who have been in to see us the last 6 months or so, some interesting levels have been hit and breached, and some bounce from. But this is a chart here of the Dow Jones Industrial Average from January 22nd, 2018 through Friday, February 28th of 2020. So essentially 25 months. And in 25 months, the Dow Jones Industrial Average is actually down 4.5%. So the problem is that essentially we have lost money from January of 2020, January of 2018 until now. And what's concerning is how quickly what happened this past week happened in different levels that it's breached. But right now, as you can see on the far left-hand side of this screen, this is the high in January of 2018. We had a correction, and then we came back, and then we had a big falling out of bed in the fall of 2018. Then we had the strong rally back. But here we are. Same prices again as we saw back in May, June of last year. Absolutely no progress. And there are some positives and negatives about this, and we're going to go through that today. Just for those of you who may not be aware, this is actually the quickest decline from an S&P 500 peak. And now remember, just 2 weeks ago, the stock market had new all-time highs. In the space of a week, we've lost over 10% in stock market value, not bond market. The bond pieces in our portfolios are doing fine. But what's happened here is this is the longest correction, the fastest correction of over 10% from a new high in the history of the stock market. And so, again, interesting times in which we have going on here. This is a chart of the Standard & Poor's 500 Index ETF called SPY. It's one of the most liquid and highly traded ETFs out there. We use it on occasion as well. But one of the things I wanted to highlight on this chart, again, this is a chart that looks a little bit different than the Dow chart we just looked at. On the left-hand side, this is January of 18. Then we had the correction into Christmas of 18, and then we had the blast off. And here we are. And then up to new highs, and then the correction. Here's what's interesting about this, though, is that as many of you have heard me say time and time again, what the number that matters for stock markets right now is this high in 2018. It's what's called a Fibonacci number, and I won't go through all that mathematical jargon on how we get there. But this high in 2018 here in January is a very significant number from the low of 2009 as far as projections. And what you'll notice, though, is that on Friday, we came right down and touched it over here. And then up until about 3 o'clock in the afternoon, the stock market was down hard. At one point in time, at about 3:10, we were still down 900 points. We actually closed just down about 300, give or take. And so what happened was, the reason why I'm showing this is how this number is so significant as far as it's the same value over here in January of 18 as it is right now, where it bounced, is that in the last 30 minutes of trading, you see down here, this is volume data, and this is the number of things or shares that were bought and sold. Billions of dollars came in buying at the close. And so these are typically hedge funds, these are the smart money people, and they're counting on some sort of bounce happening at this level. We'll wait and see how it's looking on Monday. Right now, after hours, it was looking very good. And then we've had some more official cases or notifications of the virus in America now. And so now over this weekend, we're actually looking like we're going to be down about 500 points on Monday. But this line here that goes from the low on Friday to the high in January of 18 is absolutely key. And this is why some stuff, as you saw in your portfolios, when the break started happening this past week, and again, this whole thing happened in a week. So earlier in the week, most of you saw the small caps and other pieces got taken off up here, and then other pieces got taken off around here, and then here we are right now. So the models are working as they're supposed to. They took off pieces on the way down. The problem is that this correction, if you will, is the fastest in history, and essentially we gave up 10% of gains in essentially 5 trading days. It just shows you how certain things can happen quickly. But the good thing is what we know right now is that this number here that it bounced on Friday, which is the same level as we had in January of 2018, that's where you'd expect it to bounce if it's going to bounce and get a nice rally back. Now, my concern is, given how deep the closure of various Chinese factories are around in other places around the world, does this now push us into recession? And the models will pick that up through volume data and that sort of a thing. But that's what we're seeing right now with the SPY ETF. But as I mentioned, we do have hope for a bounce, which is a good thing. And that may actually lead us to sell all the rest of it later on in a month or two. I don't know. The models will tell us. But we actually had as of Friday, the S&P 500. This is a graph of the S&P 500 from 1990 through Friday. This is the gray line at the top. And what you see at the bottom is this is the percentage of the members of the S&P 500, so the different 500 companies that make up that index, how many of them are considered oversold, and it's an extreme rating type of a thing. So when you have little ones, it's not too big of a deal. But right now, we are at a level of oversold. How many of these companies are making 52-week lows, which is coming very close to the level we saw in December of 2019. Sorry, December of 2018, right there. And then we had a similar thing in 2015, 16 time period. So we are down here at a level where it's just screaming for a bounce and oversold. And unless horrible things happen the rest of this week, we should see some sort of floor put underneath where we are, and then a bounce that can be used to either add the positions back or to sell more based on what the models are reading. This is a graph on this chart of the S&P 500 futures market. Now, futures market is just I won't bore you with the details, but the futures market is different than the stock market, and it trades pretty much around the clock around the world. But essentially, it allows you to electronically trade the stock market using limited funds, and a lot of the hedge funds use these things to hedge their exposure. And so I can be long in the stock market, but if I'm scared about the stocks going down, I can sell futures, and essentially it gives me protection so I don't have any more losses, or as much as possible. It's a proxy for the S&P 500 index. It trades around the clock, so a lot of times it gives you truer representation of where we are in the stock market as a whole. So again, this is from January of 18 through Friday of February 28th, 2020. And what you'll notice, and this is why this one's important, there's a line here that goes from January of 18 all the way over here through February. And this is a chart pattern called a wedge, I guess is what it's called. It's also called a triangle for different people. also called a megaphone. And what's interesting is every time we touch this line in the past, so in January of 18, we touched the line and we had a correction. In the summer of 18, we had touched the line and we had a correction. In the summer of 19, here, we touched the line, had a correction, and they kept getting narrower and narrower. And then what you saw then is the stock market blasted off above this line in the fall of 19, and this caused the models to actually get more aggressive, because when it breaks out of a line like this, it usually means it's blast off time. Katie bar the door, and you're safe and adding exposure to the markets. However, we found out that because of where we're at right now, it didn't exactly happen that way. So we went up about 10%, I guess more like 5 or 6, up to the top up here in the middle of February. And then we had last week, which is all down here. Now, the reason why this is a concern is because usually when you have a breakout and it blasts off, you're fine. But when you have what's called a failed breakout, so we broke out and then we came back down through this line again. So we blasted through this line in the fall of 19, and then we hit the new highs, and then we came back down. And if I expanded the chart a little bit, you would see on one of the days of the decline, it actually stopped right here and bounced a little bit. And then one day it bounced here on this line and bounced a little bit, and then it just closed down here. So what happened, though, and the reason why this is important is that there's a saying in the stock market in investing, is that from failed moves comes fast moves. And what happens then is when you have a failed breakout, which this is what it's called right now, it's a failed breakout until we get back above this line. It's a failed breakout, and unfortunately, when you have this magnitude of a loss, these declines typically don't get overcome, or we don't get back to new highs for quite a while. It takes time. It's almost like getting a wound. You have to kind of recover from the damage that's done. And so what the larger concern when we talk to our portfolio managers on Friday and again on Saturday, and having various conference calls and things, what they're worried about is that this line was breached right here. And if it's accurate, what it typically means is that since we have this top wedge line here of the megaphone, usually what happens is we wind up touching the bottom edge of the megaphone, which is the line here from the low of 18 here in January, and this was Christmas of 18. That would mean that if this chart pattern holds true, and they don't always, and that's the key. That's why you saw partial liquidation of certain stock holdings through here and different portfolios, is that we're due for a bounce. We should get a bounce, and if we can get back above this, then maybe we're okay, this line. But if we don't, what it kind of tells us is that we're probably going back down at some point in time in the next 6 months to a year to the lows we saw in December of 2018, or we could even go lower, and it really kind of projects lower, unfortunately. But again, sometimes these patterns are off a little bit. They're just used as a guide. The models use them a little bit as triggers when to get in and out of different things. But right now, as you saw in many of your accounts, there were stock exposure was taken out, some right up here, and then some more, and then some more throughout the week. And so that has become, in order to preserve asset values and accounts, that's what that happens. And so now we're hoping that a bounce happens here, starts next week, and then you'd expect it to go back up here and touch this line, and then probably come back down a smidge and kind of work its way back to something that resembles confidence, if you will, in the stock market. I found this weekend as well. One of our portfolio managers actually was remarking on this, and this is actually a tweet that one of our folks that we follow and helps us out on occasion was just reminding us that from the beginning of the stock market, the S&P 500, 28 type of a thing, through now, 91% of price appreciation for your typical portfolio over the last 90 years, as far as percentage returns, year after year, the compounding returns actually happened from 1984 through 2007. We're going to verify that just to make sure, but it kind of makes sense only because what happened is interest rates went from 19% to zero, so that drove just that easy money drove stock market stuff going forward, stock market gains. And the problem is now that we're back at 0% interest rates typically drive stock market return over the long term. Just because the lower the interest rates, it makes it easier for companies to borrow. It makes it cheaper for consumers to spend and use. And so it just usually fuels a stock market rally. The problem is that unless we eventually go to negative interest rates, which is just an absurdity in its very nature, even though it's all over Europe, 19% to zero, we're not going to see that magnitude of decrease in interest rates anytime in the near future. And so the point that they were all trying to make with those of us on our end is that we have to be very careful in what we invest in and what we use, because we now have to look for things that have yield that are kind of fairly constructive yields, stable yields, because what we saw during that boom period may not happen the same way again, obviously. But as I mentioned, there is some interesting ideas out there right now, only because there's certain sectors that have just gotten so beat up that they're screaming buy right now. Now, our managers are not entirely ready to do that, but the one sector that is probably the most beaten down is energy. And what we found interesting when we did the research, this is actually from a website called Sentiment Trader. If you look at the ETF or the index fund for the energy sector, it's called XLE is the ETF. It's one of the bigger ETFs out there. It has Exxon and Chevron and the rest of them, the oil and energy companies in that ETF. Is that the energy companies have fallen so much, they're actually back to levels we saw at the low of 2008, 2009. And so if the ETF itself, which is made up of a good 30 to 40 energy companies, has a dividend yield of almost 9% right now. And what's interesting then is that most of those companies are in much better shape than they were in 2007, 2008 before the correction, have much better balance sheets. But anyway, what's interesting about this chart, though, is that greater than 90% of the companies in the energy space sector on the S&P 500 are below what's called panic levels. And so that means just the whole sector just got thrown out of a window. And these are companies that, whether we have green energy or not, you're still going to need oil, you're still going to need pipelines, you're still going to have gas stations. And what they found is we've only gotten to this level of oversold 4 times before in history. The first one was July of 2002. That was very close to the bottom after the dot-com crash. The other time was 2008 in October, pretty close to the bottom, but not exactly. And then the low in 2015, and then 2018 in Christmas Eve. So this is the 5th time. These are the other 4 times. But one week later, 100% of the time when we've gotten to these levels, 1 week later, energy was up on average 9%, almost 10%, 100% of the time. 2 weeks, 100% of the time, still up. 1 month, 100% of the time, still up. 2 months, 100% of the time, still up. And 3 months, 100% of the time, still up. So the point about this chart is that don't be surprised to see energy being added to your portfolio. And if you already had energy in your portfolio, that's part of the reason why you have not seen it being sold, because we are at such extreme levels of bottom and panic in the energy sector that historically this is when you want to start adding exposure, when dividend yields are at almost 9% on companies that are making money. And so don't be surprised if we start seeing some energy being added back to the portfolios over the next week or two as this thing kind of stabilizes a little bit. So if you are going to buy anything on your own, buying some energy ETFs, some of the portfolios have Enterprise Products Partners. It's a pipeline company, EPD. It has the most pristine balance sheet of all the pipeline companies, and right now has a dividend yield of 8% on that thing. So a lot of good stuff out there right now in the energy space. And then these are some of the other charts we've looked at before in the past. I won't go too deep in these. The key thing I wanted to show everybody here was going back to the very beginning is, unfortunately, we are at a level as of the close on Friday. We are down 4.5% in 25 months when you look at the Dow Jones Industrial Average. Fastest decline from a peak, from a new high, all-time new high of over 10%. Fastest decline in the history of the stock market. But so there are some signs of positivity out there. We have bounced right where we should. This is the key line here in January of 18. As I said, we bounced. And as long as we hold that line, we are in good shape. Significantly oversold. We might get a little bit more downside pressure this week coming up, but we are so overdue for a bounce, and usually the bounces come and get us right back to certain key levels. The managers are watching on that. And then the key thing, obviously, for all of this is that what caused a lot of the pieces to come out over this past week was the breaching of this line here, this megaphone line. And as I said, from failed breakouts come fast moves in the opposite direction. And so what we're hoping is that, which I would kind of begin to expect at some point in time, is that there'll be a global response from the monetary authorities to help put a floor under this, and we should be good to go. The problem is, and this is where it gets tricky, given all the research we've been doing over the last couple of days, is that in the past we've had these financial issues. They were not easily fixed, but the Federal Reserve and other central banks had the tools to fix it. When you are dealing with a virus, and hopefully this doesn't get any more serious than it currently is, it's a biological issue. And other than making money easier to use, if everybody is still hunkered down in their house and not spending money, it doesn't really help. And so that's the bugaboo of this, is that if it does get worse, there's a lot that the Federal Reserve cannot do to fix this. It just becomes an issue of the virus kind of running its course, type of a thing. And then we had that one. But again, don't be surprised to see energy being added to the portfolios, just because they're so ridiculously cheap right now and the dividend yields are so high. And if you're going to buy some of your own, that would be a good thing to do as well. But again, if you have any questions, don't hesitate to reach out to myself or the rest of our staff. We will be giving a teaching workshop at the American Cancer Society again the next 2 Saturdays. Annie will reach out to all of you. And of course, if any of you want to come in and meet face to face and go over these different issues and things that we're seeing and how you feel about it, happy to make adjustments for anybody and any folks, and kind of go from there. But we need to see what the new week will bring, and hopefully everything bounces where it should. And this would just chalk it up in another of overreactions to various stimuli in the stock market, and we can get back to business as usual. And if you have any questions, feel free to give us a call, and we will talk to you soon.